All right, let's get right into it. If you've ever even glanced at a financial chart, you know what these are. Candlestick patterns. You've heard the names, hammers, dojis, engulfing patterns. They're sold to us as this secret language of the market. But what if I told you that most of what you've been taught about them isn't just a little off, it's dangerously wrong? And here it is. This is the uncomfortable truth that gets to the very heart of this explainer. You look at academic studies, you look at data from professional trading firms, and they all point to the exact same inescapable conclusion. Relying on most of these classic patterns is, frankly, a recipe for disaster in today's markets. And this chart just says it all, doesn't it? When you run the numbers on millions of these patterns, the average success rate comes out to just 52%. I mean, that is a razor-thin edge over just flipping a coin. But here's the real kicker. Once you factor in the real-world costs, commissions, slippage, the bid-ask spread, that tiny 52% edge almost always vanishes and turns into a net loss. You are, statistically speaking, better off doing absolutely nothing. So how do we fix this? Well, we're going to tear this whole topic down to the studs and rebuild it the right way. First, we'll bust the myth, then dig into why most of these patterns fail. Then the good stuff. We'll reveal the 5 patterns that actually do have a real statistical edge. After that, we'll talk about why context is king, lay out a professional's framework, and then take a quick peek into the future of pattern analysis. Okay, let's really unpack that 52% problem. The myth is that you see a pattern and it's a signal to act. But the reality is, in a world where algorithms are behind more than 60% of all trades, any simple, widely known edge gets wiped out almost instantly. That little 2% statistical blip, it's not a signal, it's just noise. Now, what's so fascinating about this is that it's not that candlesticks themselves are totally useless. The real problem is how we use them today. You see, the widespread knowledge of these patterns has ironically become their greatest weakness. It's a self-defeating prophecy. Let me show you exactly what I mean. It really boils down to 3 huge mistakes. First, people see patterns in a vacuum. They spot a hammer pattern and think, oh, buy, without even considering the bigger market trend, the volume, or if it's hitting a major price level. Second, when millions of traders and bots are all programmed to react to the exact same picture, the edge disappears. It becomes a trap for liquidity, not an advantage. And third, let's be real, these patterns were invented by race traders in the 18th century. The market has changed, just a little bit since then, you think? Okay, so if most patterns are just noise, are any of them actually worthwhile? Well, yes. After crunching decades of data, researchers and quants have identified 5 specific patterns that consistently show a real, measurable statistical edge. But, and this is a big but, only when you use them the right way. These are the ones that reflect genuine shifts in market psychology. Let's start with the one you've probably never even heard of. And honestly, that's exactly why it's so incredibly powerful. It's called the 3-line strike. It's a 4-candle pattern that looks like the trend is just going to keep on rolling, but in reality, it's one of the strongest reversal signals that exists. Just look at that number, an 83.5% success rate in predicting upward moves. That's according to some of the most comprehensive analysis ever done on the topic. Now, that is not a coin flip. That is a massive statistical edge. So the natural question is, why? Why does this one work so unbelievably well? It works because it's a trap. It's a beautiful trap. You get 3 strong down days, and that lures in all the momentum traders to go short, thinking the trend will continue. That 4th candle even opens lower, making them feel smart, and then bam, a massive reversal candle completely erases the last 3 days. All those short sellers are now trapped and are forced to buy back their positions to cut their losses. That forced buying is what fuels a violent move up. It's a classic short squeeze, and because it's so rare, the algorithms haven't been able to program it away. All right, next up we have the morning and evening star patterns. Now these are pretty well-known 3-candle reversal patterns. But the reason they still work when so many others don't comes down to one crucial piece of the puzzle that 99% of retail traders just completely ignore: volume. I mean, just look at this comparison. It's night and day. Without confirming with volume, a morning star is basically worthless, succeeding just 51% of the time. But when you add the right volume signature, where you see volume decreasing and then suddenly surging on that 3rd candle, the success rate jumps all the way to 68%. Volume tells the real story. The sellers are getting exhausted, there's a moment of indecision, and then bam, the buyers rush in with real conviction. Let's move on to our 3rd set, The piercing pattern and the dark cloud cover. These are two candle reversals, but their power isn't just in their shape. It's about a very specific psychological line in the sand that they cross. And this is what we call the midpoint rule. Think about it. For a piercing pattern to be legit, that second candle has to close above the 50% mark of the big bearish candle before it. Why is that 50% line so important? Because it means that every single trader who sold in the top half of that previous candle is now officially losing money. That creates panic, and it forces them to buy back their positions to cover, which just adds more fuel to the reversal. Now for something a little different. Unlike the reversal patterns we've just talked about, the 3 white soldiers and 3 black crows are all about momentum. Their job isn't to predict a turn. Their job is to confirm that a new trend has some serious, sustained power behind it.
The key here is to change how you think about this pattern. You don't use it to find an entry point. You use it as a filter. The data shows that after a stock breaks out of a range, if that breakout is followed by 3 white soldiers, there's a 71% chance it's going to keep going higher. This pattern is your best friend for avoiding those fake breakouts that trap so many traders. It confirms that the big money, the institutions, are on board.
And finally, we have the simplest and sometimes the most powerful pattern of them all, the Marubozu. This is just a candle with no wicks or really tiny ones. It's nothing but pure, unfiltered directional conviction. Think about what a bullish Marubozu means. The stock opened at its absolute low for the day and closed at its absolute high. The buyers were in complete, total control from the opening bell to the close. This isn't a flicker on a screen that can be easily faked by some high-frequency trading bot. This requires sustained, session-long pressure, which is almost always the footprint of genuine institutional buying or selling. So there you have it, our 5 patterns. But now we get to what is, without a doubt, the most important lesson of this entire explainer. A pattern in isolation is completely and utterly meaningless. To use these effectively, you have to stop seeing shapes on a screen and start thinking like a professional. And this right here is the fundamental difference. The amateur sees a hammer and just buys. The professional sees a hammer forming at a major historical support level, with bullish divergence on their momentum indicator on higher than average volume and confirmed by a bullish signal on a higher time frame. See the difference? They aren't just trading a pattern, they are trading a high probability setup that is backed by multiple layers of converging evidence. So how do you actually do that in practice? It's not about gut feelings or guesswork. It requires a disciplined, systematic process. This is the kind of framework that separates consistent profit from random gambling. This is what it really looks like. A pro doesn't just see a pattern and hit buy. They have a system. First, they use software to filter for only those high-probability setups we just talked about. Second, they validate it across multiple time frames. Does the 15-minute chart agree with the daily chart? Then comes the real work, contextual analysis. Is it at a key level? Does volume confirm it? After all of that, and only then, do they define their exact risk before they ever enter the trade. They size their position based on their conviction, and they have clear, pre-planned exits for both profit and loss. And maybe the most important part, they track everything, every single trade, every outcome, because this isn't an emotional hobby, it's a data-driven business. And this whole data-driven approach is only getting more intense. The future of pattern analysis isn't about digging up some other ancient Japanese pattern. No, it's about using technology like AI and machine learning to find subtle statistical edges that the human eye could never, ever hope to spot on its own. So this all brings us to the final and most crucial question that you really need to ask yourself. Are you trading patterns, or are you trading probabilities? Are you just hunting for shapes on a chart, following old folklore? Or are you a systematic analyst using these patterns as just one tool in your toolbox to identify and execute on high-probability scenarios? Because that shift, from being a pattern matcher to a probability thinker, that is the single biggest step you can take towards succeeding in the markets today.